Ever wondered how Warren Buffett, often known as the Oracle of Omaha, made his billions in the stock market? This financial titan, hailing from a modest background in Omaha, Nebraska, has a story that's nothing short of inspiring. Buffett's journey to becoming one of the world's wealthiest individuals is a testament to his sharp intellect, unwavering patience, and savvy investment strategies. From delivering newspapers to owning multinational conglomerates, Buffett's ascent in the world of finance has been marked by his keen understanding of the stock market and a unique approach to investing. He didn't strike gold overnight. Instead, he built his empire slowly, steadily, and surely, proving that in the world of investing, haste indeed makes waste. Buffett's success is not a secret locked away in a vault, it's a set of principles that anyone can learn and apply. Now, wouldn't you like to know how he did it? Let's dive into his winning strategies. Buffett's first and perhaps most famous strategy is value investing. This simple yet effective approach to investing has been a cornerstone of Buffett's success. So what exactly is value investing? In its essence, value investing is the practice of buying stocks that appear to be undervalued by the market. These are shares in companies that, for whatever reason, are trading for less than their intrinsic or true value. Just like a savvy shopper at a garage sale, a value investor seeks out these hidden gems, confident that their true worth will eventually be recognized by the market. But how does one determine if a stock is undervalued? Buffett doesn't rely on market trends or speculation. Instead, he looks at the fundamentals. He examines a company's balance sheet, income statement, and cash flow statement to understand its financial health. He scrutinizes its management team, business model, and competitive position to assess its long-term prospects. In short, Buffett doesn't just look at the price tag, he investigates what's behind it. Now, it's important to note that undervalued doesn't necessarily mean cheap. A stock can have a high price per share and still be undervalued if the company's fundamentals suggest it's worth even more. Similarly, a stock can be cheap and overvalued if the company's prospects are poor. Buffett's genius lies in his ability to distinguish between the two, to separate the wheat from the chaff. But why go through all this trouble? Why not just buy stocks in big, well-known companies and hope for the best? Well, the beauty of value investing lies in its potential for high returns. When the market eventually corrects itself and the true value of these undervalued stocks is recognized, their prices rise, often significantly. And that's when value investors like Buffett reap their rewards. So there you have it. By buying undervalued stocks, Buffett is able to maximize his return on investment when the market corrects itself. It's a strategy that requires patience, discipline, and a keen eye for value. But as Buffett's success shows, it's a strategy that can pay off handsomely. Buffett's second strategy is all about the long game. So, what does this entail? Well, it's fairly simple. Instead of chasing quick profits and short-term gains, Buffett focuses on long-term growth. He's not interested in the latest trend or the hottest stock of the moment. He's interested in companies that have a proven track record of success and a strong potential for future growth. In essence, he's playing chess while everyone else is playing checkers. But why does this work? How does focusing on long-term growth benefit an investor? The answer lies in the power of compounding. When you invest in a company for the long term, you're not just benefiting from the profits it makes today. You're also benefiting from the profits it will make tomorrow, and the day after that, and the day after that. Over time, these profits can compound, leading to exponential growth. Think of it like planting a seed. In the short term, you might not see much, but given enough time and the right conditions, that seed can grow into a mighty tree. That's the power of long-term investing. Furthermore, by focusing on the long term, Buffett is able to ride out market volatility. He understands that the market is unpredictable and can fluctuate wildly from day to day. But over the long term, these fluctuations tend to even out. So while others might panic and sell at the first sign of trouble, Buffett stays calm, sticks to his strategy, and often comes out ahead. In fact, this long-term approach is so integral to Buffett's success that he once famously said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. So there you have it. The long game, as played by one of the most successful investors of our time. With a long-term perspective, Buffett is able to ignore short-term market fluctuations and focus on the bigger picture. Buffett's third strategy is to understand your investments. This isn't about having a shallow knowledge of what a company does. It's about delving deep into the business model, the industry, the competition, and the factors that could affect its performance. Warren Buffett is known for investing only in businesses he comprehends thoroughly. He's not one to chase after the newest tech startup or the latest market fad. He sticks to industries and companies he understands, and that's where he finds his success. Doing your own research is fundamental to this strategy. It's about not relying solely on tips or hearsay, but investing time to understand a company's financials, its position in the market, and its potential for growth. This approach allows you to better predict a company's performance, and hence, your investment's return. By understanding his investments, Buffett is able to make informed decisions and minimize risk. And so can you by following this simple yet effective strategy. So, what are the key takeaways from Buffett's investment strategies? The Oracle of Omaha has long been a champion of value investing, seeking out companies that are undervalued by the market but have strong fundamentals. This approach not only offers the potential for high returns, but also reduces risk by focusing on intrinsic value, rather than market trends. Buffett's long-term thinking is another cornerstone of his success. He invests in businesses he believes will be profitable for years to come, not just those making a quick splash in the market. This strategy encourages patience and discipline, key traits of any successful investor. Finally, understanding your investments is critical. Buffett never puts his money into businesses he doesn't comprehend. This ensures a solid foundation for decision-making and reduces the chance of costly mistakes. By adopting Buffett's strategies, you too can become a savvy investor and start building your own fortune. Thanks for watching the video. Don't forget to subscribe to our channel for more investment tips and strategies.